11 bank stocks tank again, fueling financial crisis dumpster fire. What a headline, huh? Dumpster fire. Like, that's a little overused these days, but all right, let's take a look. Just when you thought the S&P 500 banking crisis was over, by the way, I didn't ever think it was over, so I don't know what that is. Tanking financial stocks remind investors the crisis still rages. So we got dumpster fire and rages. All right. Shares of 11 bank stocks in the SPDR S&P 500 bank, including First Republic Bank, which that's been under major problems for a while here. They lost so many deposits. Atlantic Union Bank shares and Northern Trust dropped 6% or much more on Tuesday, says Investor Business Daily's and analysts of data from S&P 500 Global Market Intelligence and MarketSmith. First Republic alone plunged 40% in one day following its disclosure that its depositors from customers fell $104 billion from $176 billion in the fourth quarter. Yeah, you're going to keep making deposits in a regional bank that you don't think is going to make it. And so this is why my advice is, as much as I don't love it, just go with the Bank of Americas and the Chase, the ones that get to buy these businesses. And I'm just not really comfortable with a lot of regional banks. It says that's exactly the kind of scare bank investors don't want to deal with right now. It was a devastating quarter for First Republic, says, an analyst, Alexander Yoakum. Their brand has been severely tarnished over the last 2 months, noting many high-profile advisors have been leaving the bank. So all of the more than 94 stocks in the SPDR S&P 500 exchange-traded fund fell on Tuesday on the heels of the First Republic Bank, and some of it selling in more severe than can be easily ignored. Nearly 20% of the banks on the ETF dropped, and that's exchange-traded fund, more than 5% on the day. Keep in mind, too, this is additional pain heaped on top of an already vicious selling. These bank stocks on average already lost more than a third of their value this year, a third of their value. And what about the narrative that the smaller banks will merge as depositors shift to larger banks? There's truth to that. Shares of JP Morgan Chase are up 3% this year. Yeah, Chase is going to make it. They finance so many things that are important to this country. They're kind of in the too big to fail, and the other ones are in the too small to succeed category. It says, but that doesn't soothe the pain of the bank ETF dominated by smaller bank stocks. All the bank stocks in the ETF, on the other hand, are down an average of 1% this year so far. The SPDR Exchange Trade Fund itself is down 22%. So here's the thing. We've got 3 banks that went under. They took $36 billion of the $123 billion at the FDIC. We've got high interest rates where banks were flooded with cash through quantitative easing, where the Fed handed them money. They were sitting on that cash and thinking they would stabilize, and what they use is cash equivalents like treasuries, treasury bills, bonds, and notes, which are issued by the government, and those interest rates have gone up. So if banks have to give money to the depositors when interest rates go up, the value of those cash equivalents or treasuries are down because they have to sell it at a loss because everyone else is buying the new bonds that are paying a higher interest rate. So the Fed is a huge part of why we are facing this problem with the banks. One, because every bank can lend out $1 more than once through fractionalized banking and only have to have a reserve requirement. 2, because those reserves are actually stored in treasuries and interest rates going up to so-called battle inflation. Yes, it does battle inflation, but it was a war that was waged by the Federal Reserve in the first place, is creating all this risk. It says First Republic Bank, poster child of pain. When you're looking for when a bank pain is the most severe, it's First Republic Bank. Following the 47% drop on a Wednesday, right? Shares of the San Francisco Bank are down 93% this year. Investors are fearful. The bank shares some of the traits of other banks that fell, like Silicon Valley Bank, First Republic, and I think there was Signature Bank also went out, right? So next for us is PacWest, which is down 55%, and so they just kind of keep going and talking about these regional banks that are down. So this says it was an eventful start to the year across the industry. Atlantic Union CEO John Ashbury told investors on Tuesday, early in the quarter, despite rate competition hitting a tipping point and rapidly intensified as idle funds went in search for higher yielding alternatives, right? So if you can go get higher interest rates because you've got internet banking out there, or you're worried about having more than $250,000 at a bank and you want to move that so it's still FDIC protected, like you just see people aren't making deposits because cash doesn't feel safe because there's a debt ceiling where if they don't raise that, there could be defaults. they're going to raise it. It's just a matter of when. And if they default, it would be a much bigger problem. And unfortunately, they get to use these excuses if we can't default in investors because people won't bring money to America and Americans won't trust the government. I don't really think we trust the government already at this point. So this has been a problem a long time in the making. So you see it talks about the back-to-back failures of Silicon Valley Bank, Signature Bank. Yeah, just 3 banks, $36 billion in the FDIC. So more bad news came from Northern Trust. Shares of the Chicago-based bank tanked nearly 10% Tuesday after it reported nearly 15% fall in first quarter profit. See, when you're able to borrow money really inexpensively, like in 2020, 2021, and half of 2022, these banks could borrow money so cheap and then they can lend it out. So they're getting it for less than 1%. Think about how you get like 0.25% in a savings account. Now there's a JP Morgan product where you get 4% in a checking account. So higher interest rates means lower spreads. If I could buy, say this phone for $1,000 and sell it for $4,000, that's a 400% markup. But if all of a sudden this phone cost $2,500, even if I could sell it for $5,000 or $2,500, I could sell it for $5,000. This is obviously not what you'd want to pay for a phone, but it would be 100% markup. So a fourth of that, even though they're charging more for the phone, what they're buying it, their cost of goods sold, their lending rate is really kind of problematic. So investors hope the government could wish away the bank crisis, but it seems investors need more than just promises. This is my concern. Having your money in a bank, banks are in trouble right now. The government, I guess, will come and bail them out, but they have their own problems with $31.4 trillion of debt and needing a permission and a vote to get past this debt ceiling and be able to, increase and have more. So this article is just talking about the major problems that we're facing right now. And I would say, look at cash values. Cashflowbanking.gg would be an alternative of where you could go put your money and secure it with more benefits and have access to it before 59.5 without taxes. So this has been a never fail me strategy. I would definitely check it out because it's an alternative that they're not talking about here and they're just giving you bad news. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from. So go ahead and click through and watch the next video now.